Inflation is like a silent thief that slowly steals your money's value. One day, you might buy a cup of coffee for $2, but a few years later, the same cup could cost $3 or more. This is what inflation does. It makes everything more expensive over time. Recently, many people have felt the pinch as prices for groceries, gas, and rent have gone up. This raises a big question. How can you protect your money from losing value? One way is through smart investing. But with so many options out there, it can be hard to know where to put your money. Should you dive into the world of cryptocurrencies, stick with traditional stocks, or invest in real estate? Each choice has its own pros and cons, and what works for one person might not work for another. In this video, we will explore these 3 investment options. By the end, you'll have a better idea of where to invest your money to keep its value safe from inflation. Number 1. Understanding inflation. Inflation is when the prices of goods and services go up over time. This means that your money buys less than it did before. For example, if a loaf of bread cost $1 last year but costs $1.10 this year, that's inflation. There are several reasons why inflation happens. Sometimes, it's because there's more money in the economy, which makes each dollar worth less. Other times, it's because the costs of producing goods and services go up, which pushes prices higher. Inflation isn't always bad. A small amount of inflation is normal and can even be good for the economy. It encourages people to spend and invest rather than just save their money. But when inflation is too high, it can cause problems. Prices rise quickly and people's savings lose value faster than they can earn more. Looking back in history, we can see how inflation has affected people's lives. For instance, in the 1970s, many countries experienced very high inflation, which made everyday life more expensive and uncertain. Today, we are seeing inflation rise again, which is why it's important to understand how it works and what you can do to protect your money. Number 2. Cryptocurrency. Cryptocurrency is a new type of digital money. Unlike traditional money, which is controlled by governments and banks, cryptocurrency is decentralized. This means no single person or organization controls it. The most well-known cryptocurrencies are Bitcoin and Ethereum, but there are thousands of others. Advantages of cryptocurrency. Decentralization. Since cryptocurrencies aren't controlled by any government or central bank, they are less affected by inflation caused by policies. This can make them a good hedge against inflation. Limited supply. Cryptocurrencies like Bitcoin have a limited supply. Only 21 million Bitcoins will ever be created. This scarcity can help protect against inflation, similar to how gold works. High returns. Many people have made significant profits by investing in cryptocurrencies. For example, Bitcoin's price went from less than $1 in 2010 to over $60,000 at its peak in 2021. These high returns can make crypto an attractive investment. Risks of cryptocurrency. Volatility. Cryptocurrencies are known for their price swings. One day, the price can skyrocket, and the next, it can plummet. This makes them a risky investment, especially if you need your money in the short term. Regulatory risks. Governments around the world are still figuring out how to regulate cryptocurrencies. Some countries have banned them, while others are considering stricter regulations. This uncertainty can affect the value of cryptocurrencies. Security concerns. Because cryptocurrencies are digital, they can be targets for hackers. If you lose your private key, a type of password, you could lose access to your investment forever. Additionally, exchanges where people buy and sell cryptocurrencies have been hacked, leading to significant losses. Consider the story of Tim, an early Bitcoin investor. Tim bought Bitcoin in 2013 when it was priced at around $100 per coin. He believed in the technology and its potential to change the financial world. By 2021, the value of his investment had grown immensely, making him a millionaire. Cryptocurrency can be a powerful tool to fight inflation due to its decentralized nature, limited supply, and potential for high returns. However, it comes with significant risks. It's important to weigh these pros and cons carefully and consider your own risk tolerance before investing in cryptocurrencies. Number 3. Stocks. Stocks are shares of ownership in a company. When you buy a stock, you own a small part of that company. The stock market is where these shares are bought and sold. Investing in stocks is one of the most common ways people try to grow their money and protect it from inflation. Advantages of stocks. Historical performance. Over the long term, the stock market has generally outpaced inflation. This means that, on average, stocks tend to increase in value more than the cost of living. For example, the S&P 500, a group of 500 large companies in the U.S., has historically given annual returns of about 10%. Dividends. Many companies pay dividends, which are regular payments to shareholders. These payments can provide a steady income, which can help offset the effects of inflation. Even if stock prices fluctuate, dividends can offer some financial stability. Diversification. The stock market offers many different types of companies in various industries. By investing in a mix of sectors, like technology, healthcare, and consumer goods, you can spread out your risk. This diversification can protect you if one sector performs poorly. Risks of stocks. Market volatility. Stock prices can be very volatile, meaning they can go up and down quickly. This can be stressful for investors, especially if they need their money in the short term. For example, the stock market saw sharp declines during the 2008 financial crisis and the 2020 COVID-19 pandemic. Economic dependency. Stocks are closely tied to the overall economy. If the economy is doing well, stocks usually go up. But if there's a recession, stock prices can fall. This dependency means that stocks can be risky during economic downturns. Company performance. The value of your stock depends on how well the company performs. If a company faces problems like poor management, competition, or financial issues, its stock price can drop. This makes it important to research and choose companies carefully. Stocks can be an effective way to fight inflation due to their historical performance and potential for dividend income. However, they come with risks like market volatility, economic dependency, and the need for careful company selection. Understanding these factors can help you decide if stocks are the right investment for you. If you're willing to invest for the long term and handle market ups and downs, stocks can be a valuable part of your investment strategy. Number 4. Real estate. Real estate involves buying property, such as houses, apartments, or commercial buildings. Many people consider real estate a solid investment because it provides a tangible asset you can see and touch. Investing in real estate can offer both income and potential growth in value, making it a popular choice for fighting inflation. Advantages of real estate. Tangible asset. Unlike stocks or cryptocurrencies, real estate is a physical asset. This can provide a sense of security because you own something concrete. Land and buildings have intrinsic value that usually doesn't disappear overnight. Income generation. If you own rental properties, you can earn regular income from tenants. This rental income can increase over time, helping to keep pace with or even outstrip inflation. This steady cash flow can provide financial stability and help cover the costs of the property. Appreciation. Real estate often appreciates in value over time. This means that the property you buy today could be worth much more in the future. While property values can go up and down in the short term, they have historically tended to rise over the long term. Risks of real estate. Market cycles. Real estate markets can be cyclical. Property values can rise during boom times and fall during downturns. This means that if you need to sell during a market slump, you could lose money. Liquidity issues. Real estate is not as easily bought or sold as stocks or crypto. It can take time to find a buyer and complete a sale. This lack of liquidity means you might not be able to access your money quickly in an emergency. Maintenance costs. Owning property comes with ongoing costs such as maintenance, repairs, and property taxes. These expenses can add up and affect your overall return on investment. Additionally, managing rental properties can be time-consuming and may require dealing with difficult tenants. Real estate can be a powerful tool to fight inflation due to its tangible nature, income generation, and potential for appreciation. However, it comes with risks. By understanding these advantages and risks, you can decide if real estate is the right investment for you. If you're willing to manage properties and handle the associated costs, real estate can offer substantial rewards and a hedge against inflation. When deciding where to invest your money to fight inflation, it's important to compare the options: cryptocurrency, stocks, and real estate. Each has its own benefits and risks, and what works best depends on your individual situation and goals. Risk versus reward. Cryptocurrency. Cryptos like Bitcoin and Ethereum can offer very high returns, but they are also highly volatile. Prices can rise or fall dramatically in a short time. This makes them a high-risk, high-reward option. If you are comfortable with big swings in value and can afford to take risks, cryptocurrency might be appealing. Stocks. Stocks have a long history of providing good returns that generally outpace inflation. They offer a balance of risk and reward. While stock prices can be volatile, they tend to recover over time. Dividends can provide regular income, making stocks a solid choice for many investors, especially those willing to invest for the long term. Real estate. Real estate offers stability and tangible value. Rental income can provide a steady cash flow, and properties often appreciate over time. However, real estate requires significant upfront investment and ongoing maintenance costs. It is less liquid than stocks or crypto, meaning it can be harder to sell quickly if you need cash. Historical performance. Cryptocurrency. Despite its recent history, cryptocurrency has shown the potential for incredible growth. However, it also faces regulatory uncertainties and security issues. Stocks. Historically, stocks have performed well over long periods. For example, the S&P 500 has averaged about 10% annual returns, which is higher than the inflation rate. Real estate. Real estate values tend to increase over time, and rental income can rise with inflation. However, the market can be cyclical, with periods of both high and low property values. Suitability. Cryptocurrency. Best for those with high risk tolerance and a willingness to monitor market changes closely. Stocks. Suitable for most investors, especially those with a moderate risk tolerance and a long-term investment horizon. Real estate. Ideal for those who want a tangible asset, are willing to manage properties, and can handle less liquidity. Choosing between cryptocurrency, stocks, and real estate depends on your risk tolerance, investment horizon, and financial goals. Diversifying across these options can also be a smart strategy to balance risk and reward while fighting inflation. Each option has its strengths and weaknesses, and the best choice depends on your personal risk tolerance and financial goals. Diversifying your investments can be a wise strategy to protect your money from inflation and grow your wealth over time. Now, if you want to learn how to achieve financial success, then watch this video next. And if you made it to this point of the video, please like and subscribe to the channel to see more content like this. Thanks for watching, and I'll see you in the next video.